Topic 3, indices. The news said that the share market went up today. Really? Does that possibly mean that every single share listed on the Johannesburg Stock Exchange saw a share price increase? Well, no, unlikely. What is often been referred to when we talk about the market in general like this is actually an index. So what is an index? Well, it's a benchmark and a basket of shares that we use to track the performance of the market in general. In the South African market, you'll typically hear of two benchmarks most often, such as the All Share Index, also known as the AllSy, and the Top 40 Index. Now, the AllSy is actually a basket of more than 160 shares of the most liquid traded on the exchange. And this is actually often the index that we're referring to when we're talking about the market as a whole. The Top 40 Index, by comparison, lists the largest shares that trade on the JSE by market capitalization value. So, Top 40 Index has gone up. What does that mean for you and your portfolio? Does it mean that your portfolio has seen equal rises in value? Well, not unless you are holding each one of those shares that are in the index. That's unlikely. This brings us to ETFs, which is really just short for Exchange Traded Funds. An Exchange Traded Fund is a way in which that you can trade the market without having to buy each and every one of those shares in the index. An example of an ETF is the Satrix 40 ETF. And this actually manages to replicate to its best the transactions, the market values of the Top 40 Index as it moves. A lot of new investors look at this ETF to be able to trade the market more broadly. Now, there's actually a lot of different indexes and ETFs that you can be involved in. And if you're looking to focus on certain sectors in the market, you can also track, for example, the Industrial 25 and the Resource 10 Index. Another index to consider is the Dividend Plus Index. And this is a basket of shares weighted not by their market capitalization, but their one-year forecasted dividend yields. Now, talking about ETFs, they may sound familiar and you may confuse them with unit trusts. How do they differ? Well, really from three different ways. First of all, unit trusts are managed funds where investment managers invest in different asset classes and then sell those off to the potential investor in units. And you buy them directly from the issuer. ETFs are shares, and they are traded on the Johannesburg Stock Exchange. There's also some differences in their price changes. Unit trusts have one price per day, whereas once again, an ETF is considered very much a share and in fact moves and fluctuates on a daily, intraday basis. Another difference to consider is the asset classes that these two different investments cover. Typically, a unit trust involves money that is managed on your behalf in a variety of different asset classes, such as bonds, shares, of course, and even the foreign exchange markets, whereas the ETF are usually more specific to shares.